Hello and welcome to ETF Atlas. My name is Jack Lempart and I'm thrilled to guide you through today's conversation. At ETF Atlas, we host the world's largest ETF database covering funds from the United States, Canada and Europe. In fact, if you can't find an ETF on our platform, it's probably because it hasn't been invented yet. Today, we're joined by Larry Swedroe, whose journey from the trading floors of Wall Street to becoming one of the most respected voices in evidence-based investing spans nearly 5 decades. Larry, for listeners who may not know you yet, could you introduce yourself and tell us about your remarkable transition from corporate treasury management at Citicorp and Prudential Home Mortgage to becoming the very prolific investment educator you are today?
Well, it's a pretty long, interesting story with a lot of, you might say, Woody Allen-ish events taking place. I don't know if you're familiar with the movie Zelig, just being at the right place at the right time. He changed history. I was lucky enough to be in the right places at the right time. And so I'll see if I can walk through that. So I went to both undergraduate and graduate school to be a financial analyst and security portfolio manager. That was my dream as a child. My dad had got me interested in individual stocks, and I was investing along with him, and that's what I wanted to do. And despite graduating at the top of my class from one of the leading MBA programs in the country at NYU, having graduated right in the middle of the worst stock market crash since the Great Depression, 73-4, and Wall Street was in deep trouble because the commission that was fixed at the time went away and commissions collapsed and earnings were collapsing. It was very hard to get a job on Wall Street. People who had 25 years experience were being offered similar compensation to what someone newly out of school. So it's hard to get a job then. I ended up taking a job at CBS in their corporate area, and I was in their international finance area. They had just established a position of assistant treasurer of international finance because we had a big revolution, if you will, in finance, floating exchange rates into the Bretton Woods agreements, and corporations now had to manage, foreign exchange risk, and interest rates are flying all over and everything else. So I was lucky enough to be there, and I went on to take more classes in my MBA to get, in effect, a second master's in international trade theory and economics. And 2 years later, Citicorp set up a team to advise multinational corporations on the management of these risks. And in the land of blind, the one-eyed man, they say, is king. I had all of 2 years experience. I was all of 24 years old. And Citicorp hired me to advise other multinational corporations. And then 2 years later, they sent me out to San Francisco, having helped build a successful team there at Citicorp to start up a West Coast investment bank to regionalize our presence. So I was sent out there to run included in my job was building a team, but also running a foreign exchange trading room, funding an offshore bank. I had never done any of those things, but I had to learn about the management of those risks. And a second revolution happened to be occurring, which was the creation of what Warren Buffett called the weapons of financial destruction, called derivatives. And at Citicorp was one of the two leaders in that space, along with Salomon Brothers, creating instruments to allow corporations to hedge interest rate risk, foreign exchange risk with options and floating swapping fixed to floating rate debt. All kinds of derivative securities were created. And I was there for part of that. And then after doing that for 8 years, my boss left to head Citicorp Homeowners Mortgage, and he asked me to join them It was a new, exciting area. Time for me to do something different, I thought. And so I joined them at the time when Citicorp issued the first non Fannie Mae, Freddie Mac mortgage-backed security. I didn't even know there was a T in mortgages. But there was a third revolution that was really big in that world. And I was part of it. Eventually, a team of us left to turn around the company run by Prudential and Solomon Brothers called Prudential Home Mortgage. And I was responsible there for all of the credit risk management, all of the liquidity risk management, how to fund a major bank, in effect, to fund the mortgages. And then after successfully building that company, eventually selling it, I was going to retire and teach. I had guest lectured at Stanford and some other places, and that was really where my heart was. And friends of mine had told me they had started this wealth management firm. And they were great financial planners, but they didn't know really anything about investing or managing risk. They were going to use Morningstar's rating systems to choose funds and stuff. And I told them I'd come on board to take care of the investment side. They would do the planning side, and it was a great fit. And then I ended up starting to write books to explain this. But that timing was perfect because the next big revolution that I happened to be there was Farmer and French had published their famous paper on the converting the way we think about investing from a single factor CAPM world under Sharpe to a new 3-factor world of size and value as other factors, which eventually led to discovery or uncovering of other factors. So I was lucky enough to be there for all 4, just at the right time and place, which gave me really good experience in learning how to think about risk, managing risk, planning for black swan events and things that had never happened, learning that they would and could happen, and how do you build portfolios that are, if you will, anti-fragile, to use Nicholas Taleb's term. And so when I got to Buckingham, they didn't have any marketing material to explain this new strategy that we were going to use, using systematic strategies that took advantage of factors or traits and characteristics. So I set out to write a brochure, put together a 40-page brochure to explain this. And then I went and looked. I said, we need a good book to have people to read because of the power of the print word. I went to the library, read everything that I could find. And there was only really, I thought, one good book, Burton Malkill's A Random Walk Down Wall Street. And the problem with the book was twofold. One, it was very thick, beyond what I thought many might read. And the second problem, well, it told you how markets worked and how efficient they were and how difficult it was to beat the market through active strategies. Didn't tell you really what to do with that information, how to build a diversified portfolio. So I said, all right, let me take a crack. I had a 40-page outline in effect, sat down to write, and then began my writing career.
Larry, thank you very much for this impressive introduction. I have plenty of topics to cover today, and I'm now sure that I have the right person in front of me. You've written an astounding 18 books on investing. That's nearly one book. I calculated one book every 18 months since your first publication in 1998. And I wanted to ask you what drives this incredible productivity and how do you manage to consistently find new angles and insights to share with investors after all these years?
Yeah, well, actually, technically, you could say it's 21 books because I've written 3 sequels. So depending on how you count. But in my role as head of research for what was then Buckingham Strategic Wealth, eventually it became part of Focus Financial Partners. My job was to stay on top of the empirical research because we told our clients that everything we were doing was not our opinions, but based upon empirical research findings, which could give them more confidence that the outcomes were likely to lead to the best results. So I was constantly reading the literature. I have a list of about 30 publications. I read all of them, or at least skim through the articles to find ones that I think are of importance. I then would write up to make it easy for people to understand these dense 70-page academic papers with their formulas and everything. And I would write up a 3, 4, 5-page piece that explained what the research looked at, what it found, and most importantly, what were the takeaways for investors. So after doing that for a few years, I said, gee, I think I've got the makings of a book here. And so I would write a book based upon that. And then I would look for different angles. I eventually wrote books on your guide to alternative investing, to bond investing. I would write books on behavioral finance, which to me is maybe the most fascinating field, the study of human behavior and how as human beings we make mistakes of all kinds. And why wouldn't we think we'd make those same mistakes in investing? And my job was to help people recognize those mistakes and explain then, if you're aware of them, at least you have a better chance of correcting or avoiding them. So I continue to write because that's my passion. It's sort of my way of giving back. I grew up sleeping in the kitchen in my first few years of a lower middle income apartment. And I ended up being able to retire at the age of 45, having been part of a team that sold a company owned by Prudential, which we participated in for over $1 billion. And I didn't need to work anymore. And pretty much only in America could somebody go through that experience. And my idea was to give back by helping educate investors, because neither Wall Street or the media, I'd learned, want investors to learn what is the right strategy, because what's the right strategy for investors is the loser's game for Wall Street and the media, because then they want you to pay attention to the news, to trade a lot, because that's how they make money. And the empirical evidence shows that's the wrong strategy. So that's been my mission, if you will, to help educate investors on what I believe are the winning strategies.
Before we dive into the technical discussions, you mentioned in your book, Enrich Your Future, that you're an avid whitewater rafter. And I wanted to ask you, how has navigating, class 4 and class 5, I was reading about it, rapids influenced your approach to navigating volatile financial markets? Are there maybe some parallels between reading water and reading market conditions?
Yeah, I never thought of it in that way. But, if you think about it, number one, I would say a part of the reason I love whitewater rafting is the thrill. And that was part of why I got interested in investing initially, was the thrill, of the hunt, if you will, to try to beat the markets, etc. So that's one. It is exciting, but I tell people, if you need excitement from your stocks, go to the racetrack, willing to lose $100, go to Las Vegas, have an entertainment account. That's fine. But you don't take your retirement money to the lottery ticket office, and you shouldn't take it to the Merrill Lynch office either, right? It's not about excitement. It's about, or should be about, giving yourself the greatest odds of success. The other thing I would say, now that you asked the question, is when you're whitewater rafting, the travel down the safest route, it changes based upon the water levels, whether there was a rain the night before, whether there was an avalanche, and etc. And the guides have to go ahead and scout what's ahead. And even then they know that they can't exactly predict. There could be a boulder that they can't see under the water that could flip the boat in any way. And so you have to be prepared for the unexpected and build that into your strategy.
Larry, let's start with some fundamentals that will help our listeners follow the more advanced concepts later during our discussion. Could you please explain what alpha means in investing? When we say, for example, someone generated alpha, what exactly did they accomplish?
Right. Wall Street tends to misuse that term, not always, but does. And they say any outperformance is alpha. So the S&P, for example, is up 10% and you earn 13, you generated alpha of 3%. Okay. But that can be very misleading because you could be taking, for example, a lot more risk than the S&P 500. Good example is if you invest in junk bonds versus treasury bills, you're taking two big risks. One, a maturity risk, and interest rates could go way up and you could lose money. Or of course they could come down and you make money, and you're taking credit risk as well. And so if risk shows up more than expected, you could get hurt badly, etc. So you have to benchmark against appropriate risk-adjusted benchmarks. And that's where Wall Street misleads. So a good example might be you invest in private equity that may invest in very risky startups, venture capital, and then compare it to the S&P 500. And if you outperform, you claim alpha. That's nonsensical. So you really have to be very careful when anybody talks about alpha to make sure they're using appropriate risk-adjusted benchmarks. So a simple example would be at a high level, if you have a mutual fund or ETF that buys small value stocks, you might compare the performance not to the S&P 500, but to a small value index like the S&P 600. But even there, that might not be as good a indicator as possible. There's a wonderful website that's basically free called Portfolio Visualizer that tries to create a more equal risk-adjusted weighting. So, for example, the research shows that the smallest value stocks have provided the highest returns. Okay. So you could buy a Vanguard small value fund and their average market cap, last I looked, was something like 6 billion. You could buy a dimensional small value ETF and their average market cap, last I looked, was over 3 billion. Or you could buy a Bridgeway small value stock fund and their average market cap might be $1.5 billion. Now, clearly they're taking different risks. So what Portfolio Visualizer would do is to look at how much weighting, how much exposure you have to those factors, and then adjust for that. Because you could be getting higher returns because you have more loading, if you will. And if small stocks outperform, you would expect the Bridgeway fund to do the best because it's much smaller and therefore has more exposure. But of course, if small stocks really underperform, you would expect Vanguard's fund, even if it did poorly, to do better than Bridgeway's fund. And by the way, you can look at every year virtually since both of them have been around. And whenever small value beats the S&P 500, say, Bridgeway fund outperforms Vanguard's fund and DFAs. And when small value underperforms, Vanguard's outperforms. So it's really, there's no alpha being generated there. There's no individual stock selection or market timing going on. It's just their exposure to the factors. And that's what Portfolio Visualizer does, is it risk adjusts the whole exposure and then shows you what the excess return was.
So let's dive maybe into a very interesting concept, the incredible shrinking alpha. And that's your book you wrote with Andrew Birkin. And you argue that alpha has been actually systematically converted to beta as academic research uncovers just new factors, as you mentioned. Could you walk us through this transformation and explain why what once generated alpha for early adopters like Benjamin Graham, maybe even Warren Buffett, becomes just another risk factor?
So here's the way to think about this issue. In 1960s, William Sharpe and a couple other gentlemen are given credit for creating the capital asset pricing model, or CAPM. And that model was the model that academics used up until around 1993. And it said the market's returns are explained mostly by your exposure to market beta, which is how your portfolio performs relative to the market. So if the market goes up 10% and your portfolio is going up, say, 11%, so you have more than market exposure. You own highly volatile stocks, beta being the amount of, call it simplistically, volatility. And therefore you should expect to outperform. But if you own stocks with a beta of 1.1 and you only went up 105%, not 110, your alpha was minus 5%. On the other hand, you could have a beta of 0.8 and the market went up 10%. You would only expect to go up 8% and you went up 9. So you outperform on a risk adjusted basis. It turned out that that model only explained 2/3 of the variance of returns of diversified portfolios. Okay. So along comes Warren Buffett, Benjamin Graham, etc., and they're vastly outperforming the markets, generating alpha appropriately, because the best measure we had of explaining returns was that factor model. And they are outperforming by massive amounts. And anyone who is investing in what we now call value stocks, or stocks with low price to earnings, price to cash flow, price to dividends, EBITDA to enterprise value, various value metrics, outperform, right? Today, we would not say that's alpha. Why? Because Gene Fama and Ken French came along and summarized. They didn't really discover anything. They summarized the research, which had found that value stocks outperformed, and so did small stocks. Okay.
Right.
Now, once we add those factors, now we're up to about 92% of explanatory power. So up to 93, you could, if you owned smaller value stocks, rightly you could claim alpha. Now you can't, because I can just go out and buy, for example, funds were quickly created, size and value funds, and you can own them, and you don't need any individual stock selection or market timing. So what was once alpha became beta, or a systematic factor. Now, Buffett continued to outperform, but his outperformance shrunk greatly because a lot of it was related to simply buying cheaper stocks. Okay. We go up another 4 or 5 years, and Mark Carhart comes along and discovers the momentum factor, that stocks that have outperformed relatively in the near term tend to continue to outperform for a relatively short period before mean reverting in the long term. So we now have a third factor, and that gets implemented. Before that, if you were using momentum as a strategy in selecting stocks, you could claim alpha. Now you can't, because we now have this as another explanatory factor. You still got the higher returns if those factors were generating alpha, or negative returns if they perform poorly, but you can't claim alpha. Then the next iteration came in 2013 when Robert Novi Marx uncovered this profitability or quality factor. And he showed that companies that, holding all else equal, were more profitable. Okay. And that was expanded to a quality factor by the team at AQR, Cliff Asness and team. They showed that not only profitability, but the kind of stocks Warren Buffett was buying. Not only were they more profitable, but they tended to have lower financial leverage, lower volatility of earnings, and a few other things. And they wrote a paper called Buffett's Alpha. And they then showed that you added this now fourth factor, profitability or quality. Buffett's alpha, while still there, was so minor that it was no longer statistically significant. And very quickly, we have mutual funds, ETFs, incorporating these factors into strategies. So now those profits, you can't claim it's alpha because it's beta, at least appropriately. And very quickly, as we mentioned, fund families like Dimensional and AQR and BlackRock and others began incorporating these into their strategies. You no longer had to pay fund managers high fees to get that. You could get much cheaper either index funds or ETFs. Even, for example, the S&P 600 is not just a size. They have a 600 value, which isn't just small value. It actually incorporates profitability or quality, other factors. Okay, so that's the first step in why alpha was shrinking. And by the way, in 1998, when my first book was published, 20% of active managers were generating statistically significant alpha. Now, I still think that's a bad odds of playing that game, 4-1 against you, but that was before taxes. And once you include taxes, which are the largest expense most investors who are taxable face, that number was probably 10%. By 2011, around the time that we got these profitability and quality factors, Fama and Friends showed that that number had dropped to 2%. And I'll explain further why that was the case. Okay, so first we have this factor conversion from alpha to beta. Second thing was, in order to generate alpha, because it's a zero-sum game, if you outperform because you have a higher weighting in NVIDIA than the market, well, that must mean somebody has to underweight NVIDIA. All stocks have to be owned by somebody, right? Okay, so you need a pool of victims to exploit. Who are the victims? And as we came out of World War II, 90% of all trading was done by individual investors. By 2010, that number had shrunk to less than 10%. So Warren Buffett, up until 2010, whenever he was trading, the odds were about 9-1. He was trading against some dumb retail money who didn't have his knowledge, not trading against Morgan Stanley, Renaissance Capital, Citadel, all these high frequency traders, etc., with all the talent. Okay, so the odds are good he could exploit that and generate alpha. Now we were faced with roughly 90% of the trading being done by institutions. So if Buffett was trading, or let's say Morgan Stanley was trading, the odds are 90%. The other side of that trade is another big player like Citadel or somebody like that. Who's the sucker at that table? Right? You have to have someone you can exploit. And you still have to overcome costs. It isn't free. You got to pay to do the research, have bid offer spreads, market impact, cost, taxes. So without the supply of victims big enough, that made it harder to generate alpha. The third thing was, when I got out of school, I was actually part of the first class that ever had a degree in finance, because up until the late 60s, there was no corporate finance theory. Finance was either part of an accounting department or an economics department, because we didn't have a CAPM and capital markets theory. Didn't really happen until the late 60s, early 70s. Now, anyone managing money today almost certainly has an advanced degree in math, likely also might even have a PhD in physics or mathematics. In fact, a co-author of my book had a PhD in physics, won the NASA award for best piece of software. Like, this is a lot smarter and more skill set than when I got out of school. Many of the people who were managing money might have been English majors who went to Morgan Stanley, got trained for several years, and then learned to become an analyst. And they have nowhere near access to the databases that investors have today. And lastly, the fourth factor, the supply of dollars chasing alpha has grown dramatically. In 1998, there were only a few hundred billion of hedge funds. Today, they're in the trillions, and these high frequency traders are exploiting. Let's say you hypothesize that there was, 100 billion of alpha available. Well, if you triple the size of the money chasing it, then the amount of alpha available has been cut by 2/3. And with tougher competition, no victims to exploit, it becomes much harder to generate alpha. So we continue to see that it's getting harder and harder to outperform the markets. And my view is, with all the high-powered computers we have now and database and artificial intelligence, we're seeing firms incorporating using large language models to uncover maybe some statistical anomalies. But once they uncover it, other people will reverse engineer it, implement it, and that anomaly either will shrink or disappear. I think, the advancing of AI may create short-term ability to generate further alpha, but that will quickly continue to shrink, and it will become harder and harder as academics uncover these sources of unique returns and risk.
Larry, you've mentioned about factors, and let's make sure that all our listeners understand what we mean by factors in investing. Then could you please explain this concept in very simple terms? I mean, what's the difference between a factor and just picking individual stocks?
Yeah, so a factor, the simple way to think about it, and I write in my books, is a factor is a trait or a characteristic that stocks can have in common. So Warren Buffett bought cheap stocks. Today we call them value, and there are many ways to define value. As I mentioned earlier, you could look for stocks with low PEs. You could look for stocks with low price to dividends, low prices to cash flow, low prices of EBITDA to enterprise value. Each of those would be a value factor. And in fact, the research shows that they all work. Some have worked better, but just to help the audience, the research shows that the best performing over the long term are ensembles of factors. Because they're all correlated, there's no reason to think one will do better all the time. In one decade, maybe price to earnings works best. The next decade, price to cash flow. Next decade, price to EBITDA to enterprise value. And weighting them may be equally, 1/n might turn out to be the best. Turns out that in all the research that these 1/n types of models work better than almost all other models, like mean variance, looking at which one produced the best risk-adjusted returns using volatility as that measure. And that's because we can't predict the future, and the past may not look exactly, or the future won't look exactly like that. So we're looking at characteristics or traits that can be systematized.
You're known for advocating evidence-based approaches. And when looking at your own investing, how would you personally think about asset allocation? What's your philosophy when it comes to balancing simplicity from one hand with factor exposure, which may sound a bit more complex to some investors?
Yeah, so I'm a big believer that the markets, while not being perfectly efficient, there are, we've gone through examples of the market being inefficient and then being discovered, and we continue to learn things. And there are a few people that we have no way to know today who they'll be in the future that will outperform, maybe skill, maybe luck. But the market is sufficiently efficient for me to believe that the odds of me outperforming either through individual stock selection or market timing are so low, it's simply not prudent to try. If you want to have some fun, you think you want to like to play the game, take 5%, 10% of your portfolio, invest that way, and the rest should be invested in systematic, disciplined strategies with a written investment policy statement. Okay. So my hypothesis about building portfolios works on these core strategies or principles. Number one, the markets are highly efficient. That means you shouldn't try to beat the market through individual stock selection or market timing. And if the market is highly efficient, it must mean the only conclusion you could draw is that all risk assets must have the same or very similar risk-adjusted returns once you account for their unique characteristics. So, for example, emerging market stocks clearly are riskier than, say, developed market stocks. They may have less developed capital markets, weaker banking systems, not as strong governance rules. There may not be as liquid markets, making them more expensive to trade, etc. So if I'm going to invest in emerging markets, I should expect a higher return there. Smaller stocks are riskier. We know cheap stocks are cheap for a reason. They probably are riskier. Okay. So that does mean that they should have higher expected returns. If you have an illiquid asset like private credit, that's a risk. You can't get your money out daily. You should get paid a risk premium for that. But once you account for those risks, they all should have similar risk-adjusted returns. It has to be true. If you don't believe that, just think about it this way. Let's say you think the U.S. is a better place to invest. It's got higher expected returns and higher risk-adjusted returns. Well, if that's the case, then investors will pull money out of non-U.S. developed markets. What will that do? It doesn't change the earnings of those companies, just changes their price. Money flows into U.S. stocks, doesn't change those earnings, just changes the price, drives the price up. And if the earnings don't change, drives expected returns down. For the other stocks, what money flew out of, it drives their price down without earnings down. So the expected returns go up until we get an equilibrium. So unless you think you're smarter than the market, and most people, if they look in the mirror, they don't see Warren Buffett, so you shouldn't try. You should think that all risk assets have similar risk-adjusted returns. And if you believe that, which you should, then the only logical strategy, I think, is hyper-diversification across unique sources of risk and return. So that means I should begin thinking, how do I think about U.S. versus international? Well, if markets are efficient, then a good starting point is the global market cap. Otherwise, I think I'm smarter. So if the world is, say, 60% U.S., on 60% U.S., on of the remaining 40%, let's say 2/3 is developed, 1/3 emerging markets, allocate that way. Then you could look at factors. How much do I want to tilt personally? And I wrote a book, Your Complete Guide to Factor Investing, to help investors think about who should tilt more, maybe to value and size, if you're willing to take those risks, invest there, and then look at other assets that are low or no correlation to the rest of the portfolio. And that means things like real estate, reinsurance, infrastructure, And I think long, short factor strategies like those run by AQR, for example, among others, trend following. You can look at commodities, gold. Each of these assets have some basis for wanting to consider them. And every investor will have to do the due diligence. I've written articles about every one of them and white papers and books on the subject. There's no right answer, but I think everyone should have a starting point that they should consider investing in each of these asset classes.
Just last question regarding factors. I wanted to ask about the pitfalls, the biggest pitfalls investors face when trying to capture factor premiums through ETFs and maybe mutual funds. How can a regular investor avoid these mistakes?
The best protection against mistakes is always education. So know your investment history. And one way to do that is read my books, and that factor book, right, will teach you what are the issues involved and understanding. But the most important thing for your listeners is to learn to avoid the mistakes of recency bias. You know, the biggest mistake I think investors make is they tend to have very short-sighted horizons. Even though they may have a 30 or 40-year investment horizon, they tend to view performance through the lens of a short-term investor. So they typically look at 3 years of performance, and if something underperforms, they panic and sell and get out and think there was a mistake somewhere. And what you end up doing is buying high after good performance, chasing performance. And when you buy high, your expected returns are now low, and they tend to sell low after periods of poor performance. Okay. And then after poor performance, valuations are low, so expected returns are high. They're always doing the exact opposite of what Warren Buffett had told them, is never market time. Just stay the course. You should rebalance. But if you can't resist, buy when everyone else is panic selling and sell when everyone else is exuberant. And they do the opposite. They think 3 years is a long time, 5 years a very long time, and 10 years is an eternity. What I point out to them is the following. Every single risk asset strategy goes through periods of long performance, underperformance. Every single one. And that means that you shouldn't avoid those asset classes because we can't predict when those underperformance periods will occur. Nobody can. But it means we need to hyper diversify so we don't have all our eggs in one basket. And the best example of that is there are this shocks most readers. There are 3 periods of at least 13 years where the S&P underperformed treasury bills. From 29 to 43, that's 15 years. 66 to 82, that's 17 years. And 2000 through 12, that's 13 years. That's 45 of the last 99 years that we have data for, almost half the period. And yet, everybody should know you shouldn't panic and sell, just keep investing, buy low. And so in other words, the strategy to invest in stocks is right, not wrong because of some outcome, right? You don't judge a strategy based on the outcome, but by the thought process, decision-making process, was it right? Well, if you don't panic and sell or shouldn't because U.S. stocks underperform poorly for those long periods, why do you sell when small stocks underperform for 3 or 5 years? Or value underperforms for 5 or 8 or even 10 years? Or emerging markets or anything else? Let me give you, I think, the most compelling example because it has an important lesson that all risk assets have self-healing mechanisms. And this is what investors don't understand. So to me, the most logical of all alternatives should be reinsurance. Why? because it's totally uncorrelated to anything. There's no duration risk, no inflation risk. Bear markets and stocks don't cause hurricanes or earthquakes, or vice versa in general. So the return should be uncorrelated. And we know insurance companies aren't dummies. They have world-class scientists who look at the data, they make their best estimates and charge premiums for the risks they're taking, right? And we have 150 years or more of data showing the returns to reinsurance, right? And Warren Buffett owns one of the world's largest reinsurance companies.
Right.
So a fund family called Stone Ridge comes out with a reinsurance fund. I think it was something like 2013 or 14. And the first few years, the stock generates about what was expected, about a 5% premium to treasury bills. Now that's a spectacular return for an uncorrelated asset. Equity-like returns and no correlation. No correlation to bonds either. The next 3 years, I think it was 2017 through 19, were horrible. The risk showed up 3 years in a row. And the fund lost a cumulative, 35, 38%. The fund before that, because it was doing well, had accumulated $5 billion in a short time period. By the end of that 3 years, it was down to $1 billion. Now, about 40% of that drop of $4 billion or 1.6 was the assets dropping. But the remainder was dumb retail money panicking and selling. What those investors failed to realize is there's a self-healing mechanism in reinsurance. What happens when fires or earthquakes or hurricanes or tornadoes cause losses? Insurance companies raise their premiums to adjust for the new data and the new risk. The underwriting standards go up, so deductibles go up. Underwriting standards also go up. Now, for example, after recent losses of hurricanes in Florida, you can't get reinsurance unless your roof and windows are meant to withstand 140 mile an hour winds. After the big fires in California, you can't get fire insurance. You're in a prone area for fires unless there's no tree within 30 feet of your house, no two trees within 30 feet of each other, no shrubs for, another 30 feet. So the risk went down, the premiums went way up, and the expected return went way up. But 80% of the investors were gone. The next 2 years, the fund returned 92%. And this year, the fund is up something, last I looked, another 18%. But 80% of the investors were gone. The same self-healing mechanism works in stocks. You get a crash, PE multiples go down, expected returns go up. Dumb retail money tends on average to flee, and they miss the rallies. Same thing happens with credit. You have recessions, defaults go up. What happens? Credit spreads widen, underwriting standards tighten, risks go down, expected returns go up. So the risk adjusted returns go way up. The key then is, since you cannot predict when we're going to have a good or bad year for hurricanes, you can't predict when we'll have a good or bad year for stocks or bonds or inflation or real estate or gold. And by the way, you think stocks have long periods of underperformance? The longest was 17 years of underperforming T-bills. Gold, the new hot asset class, from I think it was 1980 to 2002, gold lost in real terms 86% of its value as the price crashed from something like 850 to 270, and inflation went way up. And gold is supposed to be an inflation, which is nonsense. That can't be the case if you could lose 86% of its value there. But gold does well in other periods. And there's some evidence to show it has some hedging properties. Not all the time, but against some types of risk. So the key strategy is don't be a short-term investor, hyper diversify across many unique asset classes, and rebalance the portfolio as in a way that so your portfolio is taking no more risk than you have the ability, willingness, and need to take. And I wrote a book, You're a Complete Guide to a Successful and Secure Retirement, that walks through, there are 7 chapters on investing to help people learn how to build portfolios.
Larry, thank you for these explanations. I wanted to quickly touch another topic, ESG, sustainable investing. You also have a book here, Your Essential Guide to Sustainable Investing. And maybe for listeners who might be hearing this term for the very first time, can you explain what ESG actually means? And honestly, is this a genuine investment approach, or is it maybe just another marketing gimmick from fund companies?
Yeah, I'd say it's some of both. If your principles are to invest in a sustainable way and you want to incorporate your values into your investment strategy, then ESG, or environmental, social, and governance rules, can be a perfectly appropriate, rational approach. Some people, for example, incorporate their religious beliefs. There are Catholic funds that incorporate their religious beliefs. And there's obviously nothing wrong with that. But you should always think about, does that approach give me the best chance of reaching my goals? Am I paying a price in expected returns or risk to achieve my goals? And then once you identify that price or increase in risk or reduction in risk, then you could decide if it's worth it to do that. Okay. So here's the way to think about ESG investing. If a lot of investors invest using ESG principles, they will screen out, in some cases entirely, investing in some stocks. They might screen out, for example, the most common ones are sin stocks, alcohol, tobacco, gambling, defense, gun manufacturers, things like that. Okay. And if those are your values, I certainly would support your investing, excluding them. However, what you must understand, if enough investors exclude those things, okay, what does that do to the returns? Well, let's think about it this way. If all investors who are ESG investors exclude, let's say, tobacco stocks, does that change the earnings of tobacco companies? No. So, but the price of those tobacco stocks will be lower than it would be otherwise. And the price of the stocks that have good ESG scores, for whatever reason, okay, will be higher than they would without their earnings going up. So what happens is exclusions lead to sin stocks, if you will, having lower valuations, which means they have higher expected returns. And the evidence has shown, and this was known even before there was ESG investing, that sin stocks actually had the highest return. It's not, most people, if you ask them which sectors have provided the highest returns, they would say technology or healthcare likely. And it's actually tobacco and alcohol, both US and elsewhere. And it's for these reasons likely. I think tobacco stocks now have been the highest returning stocks of all. A lot of people won't buy them. And so they have low, and there's big risk for litigation or other reasons, right? Regulations and stuff. So that's the question now. I think it's a gimmick to some degree. Companies come out, mutual fund companies create product to push to exploit this demand and don't really necessarily deliver a true ESG product. It's a lot of marketing gimmick, but there is a basis and there are good companies. One good example is my co-author Sam Adams has created ESG type of real estate fund that looks at real estate in a way that's not only environmentally friendly, okay, but is protected against, for example, rising sea levels. So it's thinking about these issues. Whether the fund will outperform, time will tell.
You've written so many books that it's hard to touch all the topics you described, but I wanted to move to another one, black swans. You wrote the book Reducing the Risk of Black Swans, which focuses on the very extreme events. And for listeners new to this concept, can you explain what a black swan event is in investing? And can you give us maybe some historical examples of black swans?
Yeah, sure. So the term is used to describe an unexpected event. And how did that term develop? Well, up till around 1620s or so, the world had never, the known world that we know of, or the Western world, had never seen anything but a white swan. And then people went to Australia and found that there was, in fact, a black swan. And so that was an unexpected event, and it became the term in finance, black swans, an unexpected event. One of the things I was taught long ago in the world when I was managing a foreign exchange trade room, giving advice, is that things that never happen can and will happen, and you should never take risks that if an event occurs will blow up your company or portfolio or whatever, so you can't recover. So the way you do that is, of course, you diversify and not have too much confidence in that an event can't happen, right? So in 1973-4, the oil embargo might be considered a black swan. The Nakashima, nuclear event could be a black swan. There are many other events. Obviously, the attack on the Twin Towers, some would say, was a black swan. Okay. You could think someone might say Taiwan being invaded by China, but, there are people who predict these things. But you always have to remember that events that never happen can and will. And the only way to protect against such events is to hyper diversify your portfolio so you're not exposed to that event. For example, today, I think the highest expected returning investment is probably reinsurance, because the premiums have gone up so high and the risk has gone way down due to the tighter underwriting. I've been saying this now for 3 years. Doesn't mean you can't have a bad year next year because we get massive hurricanes. But the no loss return to the fund I'm invested in this year was in the very low 30s. You might expect 8 to 10% losses in an average year. In fact, we got one 10% loss event with the Los Angeles fires. And then there's not been another major event since then. And we may get through another year with no other major event. I would expect next year, maybe the returns come down a little bit. Capital try to chase these returns, but I think it'll take years for that to happen. So, but I don't have all of my money in reinsurance. It's 7% or 8% or whatever of my portfolio. I hyper diversify to protect against that event, no matter what I think the odds of that event happen.
Right. So let's move to another topic, retirement and life cycle investing. And I wanted to ask about the rule, the 4% rule, because you have another work with Gavin Grogan, where you discuss various withdrawal strategies, just also going beyond the traditional 4% rule. And could you please first explain what the 4% rule is, and then tell us why it might not be maybe the complete answer to that topic?
Yeah. So the 4% rule was created to give people a guideline about how much they could safely withdraw, or relatively safely withdraw, from a portfolio on an inflation adjusted basis without a high risk of running out of money. So you're alive, but you have no more portfolio. So 4% mean, let's say you had $1 million portfolio. The first year you could withdraw 40,000. If inflation was 10%, to keep the math simple, next year to maintain that standard of living, you'd have to withdraw 44,000, and so on. And the original research showed, at least in the US, that gave you a very high odds of success. But two things: it wasn't perfect, and number two, it didn't mean that things that didn't happen couldn't happen again. So, and sequence risk really matters a lot. If you get the negative events early in your withdrawal period, you don't have time to recover because you've spent down those assets. And when the market recovers, your portfolio can't, because those assets are gone. The best thing to happen is booming markets early. And then if the market falls, you're in good shape. So sequence risk is one reason why you should only take, in that study, 4%. And it wasn't perfect. Later studies showed in markets outside the US, it wouldn't have worked. Okay. Then Kevin Grogan and I, in our book on retirement planning, pointed out that our book was published, rates had collapsed after the great financial crisis, and we were basically zero T-bills and longer term bonds 2%. Well, with bonds, safe bonds providing such low yields, and stock PEs had gone way up, meaning bond expected returns in the future were not 5%, but maybe they were 2 or 3. And equity returns, people should no longer have expected 10, but maybe 7. Okay. Meant the 4% rule probably didn't work anymore. And maybe 3% was the new 4. Now we've had a recovery in bond markets, but equity markets have gone even higher. You really have to run the numbers to look at. So 4% rule should be looked at every year based upon how valuations are moving. And then you can put your portfolio into a Monte Carlo simulation, which spits out, thousands of alternate universes, we might say, of order of returns even, right? And then you can calculate. I think the only way to do proper planning is to build a portfolio, put it into a Monte Carlo simulator with your expected returns, your asset allocation, and look what the odds of success are. And then if you find your allocation is 95% odds of success, you have to ask the question, are you willing to live with a 5% odds of failure? And are there actions I could take if the risks do show up early, that, I'll cut my spending, I'll move to a lower cost area of living, I'll give up my annual vacations, I won't buy a new car, whatever it might be. If you have options, 5% may be fine. If you don't have any options, then maybe you shouldn't use that asset allocation or cut your targeted spending, or because that's too great a risk. So that's what I think one way a good financial advisor can help is to look at these alternative scenarios and then help you figure out what the right investment strategy is. There are tools available to the public to go ahead and run those things, but you'd have to know, what capital market assumptions to put in, how to run the model, make sure you're not making mistakes, which can happen when running models. So it can be pretty complex. That's one area where financial advisors certainly can add value.
I wanted to ask you about future of investing, especially given your decades in the industry. How do you see things like, for example, artificial intelligence and machine learning affecting investing? Do you think that these technologies can create new opportunities for investors, or maybe they will do something opposite? They will, for example, also make markets more efficient and harder to beat?
Well, I think, as we discussed earlier, I think they will discover inefficiencies, and that will make the market more efficient because the inefficiencies will quickly disappear. because the very act of exploiting them moves market prices towards their appropriate valuations, okay, or an equilibrium. So that's number one. I think the tools that you have from artificial intelligence will help investors be able to structure better portfolios, and you'll be, able to load your portfolio into an AI tool and ask it, what are the odds of success? Does this make sense as a good portfolio? Can you recommend improvement? Now you'd have to know, is that that AI tool giving you garbage answers or good answers, right? Today you can get false answers from models or good ones. I know, since I've used some AI tools, for example, to do research and writing, and I'll see they spit out nonsense answers, even made up hallucinogenic answers I've seen. So, but I do think we'll move where in some very simplistic cases, it will help particularly lower net worth investors be able to build simple portfolios that are well diversified and manage them using AI tools pretty simply and through 401k plans. And that'll help avoid, hopefully, a lot of the behavioral errors that people do make. Machines don't make behavioral errors.
Yeah. Let's go a bit further and maybe beyond even investing, because in your book, Enrich Your Future, you have chapter 40, The Big Rocks, where you are actually focusing on what truly matters in life. And I wanted to ask you, how has your financial success influenced your perspective on life's priorities?
Yeah, well, one thing we do know is all the research, and I've read a ton of stuff on this issue, shows that once you have your health and enough money to put food on the table, shelter, the level of happiness becomes almost irrelevant to your wealth. In other words, there is what economists will call a utility curve that kind of looks like an elephant from the side, where, your first 100 grand or $1 million is really adds a lot of value. The next million is adding more value, but not as much. And once you, let's say, have 5 million, and that means using your 4% rule, you could safely withdraw 200 grand a year. And I would argue, if you can't be happy on 200,000 a year, something's wrong with your life. Your priorities may be messed up, right? Because most of the good things in life are, once you have your health and enough money, are either free or cheap. To me, I get no more enjoyment out of life than sitting down and playing games with my 6-year-old grandson, or taking a walk in the park like I did yesterday around a beautiful lake with my wife, going out and playing pickleball on my driveway. None of those things cost me a penny. And, I get more joy out of that than eating out at some fancy restaurant and spending $500 on a meal, right? Right. So once you have enough money, the incremental value of wealth really starts to shrink. And they have found that once you reach that point, which, by the way, in the US today is about 80 grand, might be 200 grand in New York and 60 in Hope, Arkansas, because cost of living. But on average, that's true. And this evidence is true anywhere you go around the world. There's some level where once you have more, you're no more, or people are no more happy. There are really only two things that matter in determining whether you're happy or not. You care to guess what those are, John?
I have no clue.
So the first thing is what I would describe as, how many 2 o'clock in the morning friends do you have? So the depth and level of breadth of your social relationships. How many friends could you pick up the phone? I just fell down and I'm hurt. Can you come and take me to the hospital? It's 3, right? That's the first most important thing. And the second thing is what I call a reason to get up in the morning. And so it might be you go to work as a candy striper in a hospital, because that gives you feeling of contributing to society, helping others, keeps you connected, instead of sitting in front of your TV watching some reality TV program, right? So whatever it is, whether it's going to school, taking college, classes and learning a new language, going out and playing golf or tennis or pickleball, or, working in some charity, giving back to your community. It doesn't matter what it is, but it's a reason that gives you both those social connections and gives you the feeling of you're contributing and is stimulating mentally. And for me, that's why, even though I retired last July, I want to continue to do the research and writing, which I love, and it's stimulating for me, and it's my way of giving back. It's also my way of connecting with people who I've built friendships over the years. So, when I read a paper, I can pick up the phone and talk to the research team at AQR or Dimensional, or my friends Andy Birkin and many others, ask them their input on my blog. Hey, does this make sense? Did I miss anything? That's why I think my writings are as good as they are, because they're not only mine. I'm getting contributions from some of the top minds. Almost every piece I write has been reviewed by somebody else. So that's what you have to figure out, what the big rocks are in your life, what's important to you. I've mentioned a few of the things that are important to me. So the story, I don't know if you want me to tell the story of the big rocks.
Please go ahead. Yeah.
Yeah. So there was a professor on time management at a university, and she was trying to use a demonstration to a class about efficiency time management. She took a big glass pitcher, and took out a box from under a desk and put in some big rocks until no more rocks could fit in. And then she asked the class, is the jar filled? She couldn't put any more rocks in. She tried. And the class shouts out, yes. And she says, oh, really? She bends down, picks up a box of sand, pours in the sand, fills it into the brim, and asks the class, is it filled? And the class, yes. And she says, oh, really? And now she pulls out a jar of water, pitcher, and pours it in, filling in between the sand until no more water going. And she now asks the class, is the jar filled? And they say yes. Well, what's the lesson of the story? One eager student raises his hand. He says, you can always fit in one more meeting on your calendar. She says, no, that's obviously not the lesson. The lesson is, if you don't put the big rocks in first, you can never put them in. And the important thing is to figure out for you, what are the big rocks in your life, right? Is it trying to outperform the market by a little bit, or is it taking that time to go for a nice walk with your wife, sit down and play some games with your kids, read a good book? What's more important? Even if you won the alpha game, which 99% of investors likely lose, did you lose the game of life? And so I tell a true story in my book about a friend of mine named Rick. And he was an assistant treasurer at a Fortune 500 company. And he had read my book and said, Larry, I'd love to talk about, becoming a client. Tell me what your firm does. And Rick was the pension manager at this big Fortune 500 company. So he managed their dollars, and every year they would decide which active managers to give money to. And every few years they'd end up firing some managers, hiring others, never thinking about, well, if you ended up firing a manager, wasn't something wrong with the process? They never thought about that. And the problem was that past performance of active management doesn't work. So at any rate, Rick and I sat down, and he decided to become a client, and we met with his wife, and she told this story, that Rick figured out that now he was no longer going to read the newspapers, watch CNBC, watch Bloomberg, read all these reports, trying to figure out where the markets were going. And he added up, he calculated the amount of time saved. And if my memory served, there was 6 weeks a year of his life he recaptured. That was the emotional price, if you will, non-monetary price of playing the game of active investing. He was focused on the pebbles, the sand, and the water, not the big rocks. And so that his wife was so thrilled she regained the husband.
Yeah, wonderful, wonderful story. Thank you for that, Larry. Just final questions. We are reaching to the end. I wanted to ask, how do you hope your work will influence the next generation of investors? What changes maybe you would most like to see?
Yeah, well, one, I hope my work spurs them to read books like mine. On my Substack column, I've posted 3 separate lists, the dozen best finance books, the dozen most behavioral finance books, and another group of best personal finance books. Education is the armor that protects you from all this garbage marketing from Wall Street and the financial media. So it's sad that people would much rather watch some reality TV show than spend a little bit of time investing in their own personal education. And I'm hoping to educate people about what's the right strategy. You don't have to read my books, read the others I recommend. There are a lot of great authors who are writing on this subject. 25 years ago, there were very few good books. I think Bill Bernstein, myself, John Bogle, and Rick Ferry were about the few who were really writing at that time. Now you've got, I've got at least 50, I think, good books that I list, or at least 40 that I think are really worth reading. And so I would hope that by educating investors, they would get away from this game of active investing, learn not to be overconfident. I can't recommend enough my own book on behavioral finance, investment mistakes even smart people make and how to avoid them. Covers 52 mistakes. Reading that book alone should help you avoid a lot of mistakes investors make, like overconfidence, recency bias, and what I call confusing information with knowledge. If I've accomplished that, I would have certainly achieved my objective of helping people not only give them a better chance of living a well-lived life from a financial perspective, but giving them a chance to live a better life, because they won't be spending anywhere near as much time reading what I call investment pornography.
Yeah, that's a nice phrase. Where can our listeners find more of your content and stay updated on your latest research and insights?
There are 3 easy ways to do that. One, you could follow me on X or Twitter. I post all my articles, even that I write for 4 other websites. I'm an author for Financial Advisor, Wealth Management, Alpha Architect, and Morningstar. So I write every month articles for each of those publications. And then I have LinkedIn. I do the same thing. And then I have my own columns on Substack, where I publish a few articles a week typically, including providing links to the other publications out there. So those are 3 easy ways to follow my musings. Another way would be to put a Google alert on my name.
Yeah, but there will be a bunch of links linking to your work. I will put all the links in the show notes. Larry, thank you so much for this incredibly comprehensive discussion and for sharing nearly 5 decades of investment wisdom. So it was really great pleasure. And I think that the key message I hope our listeners take away from our discussion is that successful investing really doesn't have to require complexity or constant activity. It just requires discipline, evidence-based education, as you said, evidence-based principles, and the patience to let time and compound returns work the magic. So thanks again, Larry, for joining us, and continued success in your mission to educate investors. Until next time. Thank you.
My pleasure. Happy to come back, and hopefully your readers will subscribe to my Substack column so they can stay educated.
I'll encourage them to do so. Thank you so much.
Take care.
Bye-bye.